In the first segment of this podcast, we'll be talking about Donald Trump's election and how this has resulted in an increase in equity prices, as well as a strengthening of the US dollar, and also how this has caused a doubt of the Trump trade. Fernanda, can you please enlighten us a little bit about this topic and explain to us these key concepts?
Let's start with 2016 election of Donald Trump and the market reactions that followed, especially the Trump trade. After Trump's election and victory, we saw a significant surge in equity prices, long-term bond yields, and the strength of the US dollar. This was likely due to investors' optimism surrounding Trump's proposed policies, tax cuts, deregulation, and infrastructure spending that were expected to boost economic growth and corporate profits. Trump's fiscal policy, especially the tax cuts, played a big role. As we discussed in class, tax reduction for business and individuals tend to increase disposable income, which leads to higher demand and investment. As we talked in class, this in turn encouraged economic expansion, which investors believed will benefit corporate earnings. In this context, stocks were expected to rise as a result of the anticipated increase of profits. According to MACU 2018, tax cuts typically lead to higher consumption and investment, fostering economic growth. Additionally, long-term bond yield rose. This occurred because investors anticipate higher inflation due to expected increase in government spending and a potential rise in interest rates by the Federal Reserve to curb inflation. When inflation expectations rise, bond yields typically follow suit. Bernanke of 2017 explains that an increase in fiscal stimulus could lead to expectation in higher inflation, which would push bond yields, and investors seek compensation for the expected loss and purchasing power, especially power. The US dollar also appreciates because, as we know, a growing economy and higher interest rates make the US assets more attractive for foreign investors. This dynamic is well explained by the theory of interest and rate parity and how it affects currency exchange rates. As investors anticipate that the US economy would strengthen under Trump's policies, demand for the dollar surged, leading into its appreciation. To summarize, the market optimism was based on expectation of Trump policies leading to higher growth, corporate profitability, and a stronger dollar. But it's important to note that this was all driven by market expectations and not actually policy changes took time to materialize. Investors often price and anticipate changes before they happened, as we saw here.
Second segment of this podcast, we're gonna discuss Scott Bessent's nomination and how this has reacted in financial markets. Please, Sebastian, can you talk a little bit about this topic and tell us your insights?
Yeah, well, this event triggered notable movements in the market as well. Following his nomination, equity prices rose, long-term yields fell, and the dollar weakened. The market's reaction was largely due to Bessent's perceived approach to fiscal policy, which centered on promoting infrastructure investments and renewable energy projects. Bessent's emphasis on boosting infrastructure, alongside his focus on clean energy, assured investors that economic growth could be sustained over the long term. As we learned in class, investments in infrastructure often provide a multiplier effect, leading to broader economic growth and an increase in business profitability. This expectation of higher growth helped boost stock prices. Romer highlights that infrastructure investments can have long-term economic benefits, increasing productivity and reducing the cost of future economic activities. As for the bond market, Bessent's focus on fiscal discipline reassured investors, reducing concerns about government debt. His statements suggest that the US Treasury would work in harmony with the Federal Reserve to manage inflation and avoid runaway fiscal deficits, which led to falling bond yields. This is consistent with the theoretical framework of the crowding out effect, where government borrowing could potentially crowd out private investment, but Besant's focus on responsible fiscal policy reduced those risks in investors' eyes. The weaker dollar was another consequence of Besant's policies. With the reduced yields on US government bonds, foreign investors were less inclined to hold US assets, leading to a decrease in the demand for the dollar. Additionally, Besant's approach to trade and international relations may have been seen as less aggressive, which would decrease the dollar's value relative to the other currencies. In summary, Besant's nomination reinforced expectations of long-term growth, fiscal discipline, and a more stable economic environment. As we'll learn in class, these factors can drive both equity prices and bond yields, while also influencing the value of the currency.
Thank you so much, Sebastian. Those are some really interesting arguments you have dealt with us today. Now we're gonna move on to the third segment of this podcast and talk about Argentina's economic situation and the cepo concept. So let's turn our focus to Argentina and the ongoing challenge it faces, particularly regarding the cepo cambiario, our foreign exchange controls. The cepo was introduced to manage the outflow of US dollars and stabilize the country's foreign exchange reserves, but it also created a dual exchange rate system, official and blue dollar rates, which caused significant inefficiencies in the economy. The cepo restricts access to the US dollar, which negatively impacts businesses that need to import goods or service dollar-denominated debt. Companies that depend on international financing struggle to plan investments or access capital markets due to the uncertainty caused by the cepo. This is directly linked to the concept of currency risk and the challenges firms face when there is limited currency convertibility. As Mankiw and Reyes 2018 point out, exchange rate controls can distort market dynamics, leading to inefficiencies that stifle economic growth. Additionally, the cepo has eroded investor confidence. The dual exchange rate system creates a sense of unpredictability about the future value of the peso, discouraging both foreign and domestic investment. According to Obstfeld and Taylor 2017, exchange rate rigidity and controls often reduce flexibility, limiting an economy's ability to respond to external shocks and further deterring investment. From a microeconomic perspective, removing the cepo could help address these issues by fostering a more efficient allocation of resources and attracting foreign investment. However, there are risks involved. Without addressing underlying economic issues such as inflation and fiscal deficits, the removal of the cepo could lead to a sharp devaluation of the peso and increased inflation. The International Monetary Fund 2020 emphasizes that dominant currencies and entrenched structural issues can limit the benefits of exchange rate flexibility, highlighting the importance of simultaneous reforms. This scenario reflects the financial trilemma, which suggests that it is challenging for a country to maintain stable exchange rates, independent monetary policy, and free capital movement simultaneously. If Argentina removes the cepo without addressing inflation and fiscal imbalances, it risks increased exchange rate volatility and inflationary pressures. In summary, while removing the cepo could bring some benefits such as improved export competitiveness and increased foreign investments, it also carries significant risks. The government would need to carefully stabilize the economy and reduce inflationary pressures before taking such a big step. Well, that wraps up our discussion for today. The key takeaway is that market reactions are often shaped by expectations of future policies and the role of fiscal and monetary policy in shaping these expectations. The way the market responds to these events show how investors react not just to policies themselves, but to the anticipated changes that they will bring. Thanks for joining us. We hope this helped clarify the relationship between economic policies and market behavior. See you in the next episode.